Actually have more money to spend in retirement, like maybe thousands more each year.
That sounds pretty good.
Yeah, right. Extra cash for, travel, hobbies, or just feeling a bit more secure financially.
Hmm.
Well, today we're doing a deep dive into the famous 4% rule for retirement withdrawals.
Ah, yes, the cornerstone.
Exactly. And we're asking, is it maybe too cautious? Could it be unnecessarily limiting how much of your own savings you can actually access and enjoy?
It's a really important question because sticking too rigidly to it might mean leaving money on the table, so to speak.
It could feel like finding an unexpected deposit in your retirement account, potentially. So let's get into it. First off, can you quickly remind us what this 4% rule actually is?
Sure. So the basic idea is you look at your total retirement savings when you first retire.
Right.
And in that first year, you withdraw 4% of that total amount.
Got it. 4%.
Then every year after that, you take out the same dollar amount you took out the year before, but you adjust it upwards for inflation.
So your spending power keeps up with rising prices.
Exactly. The goal is to make your money last, theoretically, for about 30 years of retirement. It's become like a real standard guideline.
Okay, so it's a standard, but like any guideline, it's built on, well, assumptions, right? It's not just pulled out of thin air.
Oh, absolutely. There are several key assumptions baked into the original 4% rule calculations.
Let's unpack those. What's the first one?
Well, first, it assumes a certain mix of investments in your portfolio, typically something like 50% to 75% in stocks.
Okay, the growth part.
Right. And then the rest, maybe 25% to 50% in bonds for stability.
So a balanced portfolio, more or less.
Pretty much. Second, the original math didn't really factor in retirees having a separate stash of cash, like a buffer for market downturns.
Interesting. So it assumed you'd always pull from the invested portfolio?
Yeah. It presumes you take that withdrawal, adjusted for inflation every single year, kind of like clockwork, regardless of whether the market is booming or, tanking.
Okay. No flexibility there. What else?
It was specifically designed around a 30-year retirement horizon.
30 years. That feels specific.
And long.
It is. And finally, linked to the point about consistency, there are no built-in dynamic adjustments. You don't withdraw less if the market's bad or more if it's good, according to the original strict rule.
Okay, so hearing those assumptions, it does sound quite rigid, like a one-size-fits-all kind of thing.
It can be, yeah.
Which brings us to the core question. Why might this rigidity, this cautiousness, actually be too much for a lot of people? Why might it stop them from getting the most out of their savings?
That's exactly it. One huge factor is adaptability. Real people often don't spend the same inflation-adjusted amount every single year.
Right. Life changes. Maybe you spend more early on than less later, or vice versa.
Exactly. Or you might consciously decide to tighten your belt a bit if your portfolio takes a hit. Maybe skip the big trip that year. The strict 4% rule doesn't account for that human element, that flexibility.
Makes sense. And you mentioned the cash buffer earlier. Yeah, that's another big one. Many people do have cash savings outside their main retirement portfolio. Maybe CDs, a money market account, just checking, or savings.
So they have a cushion.
Right. Having even 1 or 2 years' worth of essential expenses in cash can be massive. If the market drops, you can live off the cash for a bit instead of selling stocks or bonds when they're down.
Avoiding selling low, basically.
Precisely. The original rule didn't really consider that strategy, and then there's that 30-year assumption.
Yeah, let's talk about that. Is 30 years the typical retirement length?
Well, the data suggests, maybe not for everyone, the average retirement starting at, say, age 62 is often shorter than 30 years.
Shorter? How much shorter?
For a man retiring at 62, the average is around 19 years. For a woman, it's closer to 22 years, significantly less than 30.
Wow. Okay, so if the rule is built for 30 years,
Mhm.
but many people have shorter retirements, that definitely implies it might be overly conservative for them.
It certainly raises the possibility, doesn't it?
So despite these potential limitations, the rule is popular because it's seen as safe. What does the actual data say about its success rate? Like, how often does it actually work in preventing people from running out of money over that 30-year span?
Okay, yeah, the track record is generally strong, which is why it gained traction. Research, for instance, from JP Morgan Chase, looking back historically, it suggests that using a 4% initial withdrawal rate with that typical stock bond mix gives you roughly a 90% chance of your money lasting for 30 years.
90%. That sounds pretty safe.
It is. Other simulations show similar results, sometimes even higher, like 90% up to maybe even 100% success rates in some historical periods. So it definitely prioritizes portfolio survival.
But what happens if you try to push that rate up a bit, say to 5% or 6%?
Well, that's where the risk starts to increase more noticeably. The studies show the probability of your portfolio lasting the full 30 years does drop significantly as you go above 4%.
Okay, so 4% is the safe zone, statistically speaking, for 30 years. But if it might be too safe for some, based on flexibility or a shorter timeline, what can people actually do? What are some strategies to potentially withdraw a bit more without completely throwing caution to the wind?
Right. This is where it gets practical. One really powerful strategy we touched on is that cash reserve.
Holding cash separately.
Exactly. Having, say, 1 to 2 years of your necessary living expenses sitting in safe, liquid cash.
How does that help you withdraw more overall?
Because when the market has a bad year or even a bad couple of years, you don't touch your investments, you live off the cash instead. This avoids locking in losses by selling when prices are low.
Letting your portfolio recover.
Precisely. And simulations suggest that just implementing this cash buffer strategy could potentially allow you to sustain a withdrawal rate that's maybe 0.5% to even a full percentage point higher than 4%.
So that could turn 4% into potentially 4.5% or even 5% just by having that cash safety net.
Potentially, yes, according to some studies. It provides immense psychological comfort, too, knowing you have that buffer during volatile times.
Okay, that makes a lot of sense.
Okay.
What else? Any other approaches?
Another major category is using dynamic or flexible withdrawal strategies.
Dynamic, meaning they change.
Yeah, instead of that rigid inflation-adjusted amount every year, you adjust your withdrawals based on how your portfolio is actually performing and maybe its current value relative to your needs.
So like take out a bit less after a bad market year.
Exactly. And maybe take out a little more after a really strong market year, within certain limits. There are different methodologies for this. You might hear names like Guyton-Klinger guardrails, or Vanguard has its own approach.
Guardrails, like setting upper and lower limits on your withdrawals.
Kind of, yeah. They prevent you from overreacting to market swings, either by spending way too much in good times or cutting back too drastically in bad times. It adds structure to the flexibility.
Interesting. So it's not just winging it.
No, not at all. It's a planned flexibility. And actually, even William Bengen, the financial planner who originally popularized the 4% rule.
The originator.
Yeah, even he later acknowledged that incorporating some flexibility based on market conditions makes a lot of sense and can improve outcomes.
So being adaptable, either with a cash buffer or a dynamic withdrawal plan.
Yeah.
That seems key. It could effectively make the 4% rule feel more like a 5% rule for some people.
That's a good way to put it, yeah. For many retirees who have some willingness to adapt, it could open the door to accessing more of their funds.
Okay, let's circle back to that retirement length point. You said the average is often less than the 30 years the rule assumes. How significantly does that potential shorter time frame impact withdrawal rate possibilities?
It's definitely a factor worth considering carefully. Let's look at some stats again, say, from the Social Security Administration.
Okay.
For a man who reaches age 62, the probability of him living beyond age 92, so more than 30 years later, is only about 12%.
Only 12%. Wow.
And for a woman reaching 62, the chance of living past 92 is a bit higher, around 22%.
Still, that means for roughly 80–90% of people retiring around that age, their retirement likely won't last the full 30 years the rule is built for.
Statistically speaking, yes. And if you retire later, say at 65 or 70, the odds of needing your money to last 30 years decrease even further.
So logically, if your money doesn't need to last as long, you could potentially afford to take out a bit more each year.
That's the logical conclusion, yes. A shorter time horizon could theoretically support a higher withdrawal rate.
But I sense a but coming.
A very important but. While averages are useful context, you are an individual, not a statistic. Planning based on averages can be dangerous.
Because you might be one of the 12% or 22% who do live longer.
Exactly. You absolutely do not want to plan for an average lifespan, overspend early on based on that assumption, and then risk running out of money if you live longer than expected. Personal health, family history of longevity. These are crucial. It's about understanding the stats, but planning conservatively for your own potential lifespan.
Absolutely crucial point. Prudence is key. Okay, let's make this really concrete. Talk about the actual dollars and cents. What kind of financial difference could moving from, say, a 4% to a 5% withdrawal rate make? Let's use an example. Say someone figures out they need $30,000 per year from their investments to live comfortably in retirement.
Okay, great example. $30,000 needed annually. If you stick strictly to the 4% rule,
You need a big pot of money to start with.
you do. To get $30,000 at a 4% withdrawal rate, you need an investment portfolio of $750,000. $30,000 divided by 0.04.
$750,000.
Mhm.
Okay. Now, what if, through flexibility or considering a shorter realistic time frame, they felt comfortable with a 5% withdrawal rate?
Big difference. At a 5% withdrawal rate, to get that same $30,000 a year, the portfolio size needed drops to $600,000. $30,000 divided by 0.05.
Wow, that's $150,000 less required savings. That's huge.
It's a massive difference, and it continues. If you could sustainably manage a 6% rate,
Let me guess, $30,000 divided by 0.0. So that's $500,000 needed.
exactly, $500,000 portfolio, that's $250,000 less than the 4% rule requirement.
And just for kicks, 7%.
At 7%, you'd need around $430,000, which is over $300,000 less than the initial $750,000 figure. The leverage is significant.
Those numbers are staggering. So what does this mean for people practically? How does needing a smaller nest egg or being able to withdraw more from a larger one actually change things in retirement?
It has potentially massive real-world implications. For someone still saving for retirement, realizing they might only need, say, $600,000 instead of $750,000 could mean
Retiring earlier.
potentially, yes. It might bring their retirement date forward by several years, which is incredibly appealing for many.
Okay, and what about for someone who already has the $750,000 saved? What does moving from 4% to 5% mean for them?
Well, they've hit their number based on the 4% rule, getting $30,000 a year. But if they determine they can safely withdraw 5%,
They get more income each year?
precisely, 5% of $750,000 is $37,500. That's an extra $7,500 every single year in retirement income compared to the 4% withdrawal.
An extra $7,500 a year. That's not small change. That could fund a really nice vacation, cover rising healthcare costs, allow for more gifts to grandkids, pursue hobbies.
All of the above. It's tangible money that directly impacts your quality of life, your choices, your freedom in retirement. It really encourages you to maybe shift your thinking a bit.
How so?
Instead of just seeing your retirement savings as this static pot you have to guard fiercely and barely touch.
You see it more as a tool.
Exactly. A tool designed to support the best possible life for you in retirement. Overly restrictive rules might actually prevent you from using that tool effectively to maximize your happiness and well-being.
That's a really powerful way to frame it. It's about making your savings work for you to live the retirement you want.
That's the goal, isn't it? The 4% rule is a fantastic starting point, a useful benchmark. We're not saying ignore it.
Don't treat it as gospel.
Right. Understand its assumptions. Then look hard at your own situation, your health, likely longevity based on family, your risk tolerance, how much flexibility you realistically have with spending. All these things might mean a different approach is better for you.
So wrapping up our deep dive today, the big takeaway seems to be the 4% rule is a helpful guideline, but it's definitely not an ironclad law you must follow.
Couldn't have said it better.
Factors like maybe having a shorter retirement horizon than 30 years, or being willing and able to adjust your spending up or down a bit with the markets,
Flexibility.
and especially having that cash reserve set aside for downturns. These things can potentially open the door to safely withdrawing a higher percentage.
Yeah, they can make a real difference to the sustainable rate.
And that higher rate translates directly into more money available for you to actually use and enjoy during your retirement years. More freedom, more options.
Which leads us to maybe a final thought, something for you, the listener, to really chew on. Think about your unique circumstances, your expected retirement length, how comfortable you truly are with market ups and downs, how willing you are to tighten the belt if needed or splurge a bit when things are good.
Considering all that,
Could a slightly higher or perhaps a more flexible withdrawal strategy actually be a better fit for your goals? Could it let you enjoy more of your hard-earned savings without undue risk?
it's definitely worth exploring beyond just the standard rule book, right? Look
Yeah.
at what truly works for your financial life and your retirement dreams.
Absolutely. It's about finding the right. Okay, so what if you discovered a path to potentially hundreds of thousands of extra dollars in your retirement as a single person? Just imagine that peace of mind, knowing you've optimized your strategy and unlocked some unexpected financial flexibility.
Yeah, that sounds pretty good.
Well, this deep dive, it really uncovers how understanding the interplay between your retirement age and when you claim Social Security could lead to a significantly more secure and maybe even a much richer future than you thought possible.
And what's fascinating to consider right from the get-go is that the retirement planning calculation, it just looks really different when you're navigating it solo.
Totally different.
Yeah, the strategies that work well for couples, they don't always translate one-to-one.
Yeah.
And that's where you find the real opportunities, but also, potential pitfalls for single retirees.
Exactly. So today, we're really laser focused on the specifics. Retirement planning just for single individuals.
Right.
We looked at some detailed projections, trying to pin down exactly what size of retirement portfolio you might need at different retirement ages, and crucially, how different Social Security claiming decisions can dramatically shift those numbers, potentially, putting a lot more money right back in your pocket over the long run.
If we connect this to the bigger picture, it's not just about hitting some arbitrary savings target, is it?
No, not all.
It's really about understanding the levers you can pull, particularly around when you retire and when you start taking Social Security. These can potentially create a much, much more favorable financial outcome for you as a single person.
Absolutely. We're going to try and break down these complexities, give you a clear understanding of the financial moves, the ones unique to retiring solo, that could unlock significant, maybe unexpected funds.
Yeah.
You'll see exactly how the timing of these key decisions impacts your required savings, creates more financial breathing room, no confusing jargon, just actionable insights tailored for you.
Okay, so the data we've examined, it makes one thing really crystal clear. The age you decide to retire. It has a profound effect on the size of the investment portfolio you'll ultimately need.
It makes sense.
It's quite logical, yeah. The more years you're retired, the longer your savings just have to sustain you.
Right. So, for example, the analysis we looked at, it indicates that if you're aiming for a relatively early retirement, let's say age 55, the financial demands are considerably higher for a single person than if you work until, say, your late 60s.
Oh, yeah.
We're talking potential differences that could easily reach, well, hundreds of thousands of dollars in required savings. A huge difference.
And this brings up a really important question, doesn't it?
Yeah.
For anyone dreaming of early retirement as a single person, are you truly prepared for that significantly larger financial commitment? Especially when you don't have a partner's income, or maybe there are Social Security benefits to draw on later.
Yeah, that's the crux of it. And let's dive into Social Security, because this is where some really significant financial benefits or drawbacks, frankly, can emerge. It all depends on your choices.
Okay.
Deciding when to start getting those benefits, it's another really powerful tool you have. Now, claiming early, like as soon as you turn 62.
Yeah, the earliest possible.
Right. It means you'll get income flowing sooner, which sounds good, but your monthly payment will be substantially lower.
Permanently lower.
Permanently lower, yeah. And this could put more pressure on your investment portfolio, especially in those first few retirement years.
On the flip side, though, if you decide to delay claiming, maybe until your full retirement age, or even push it later to age 70, you get rewarded. You get a much larger monthly benefit. And that increased income stream, particularly in your later years, can significantly reduce the amount you need to pull from your personal savings. Less pressure on the nest egg.
It's a real strategic decision, isn't it? A trade-off. And the analysis we looked at, it gives us some concrete numbers to illustrate this. So, for someone planning to retire at 55, and claim Social Security at the earliest possible time, 62.
Okay, so 7 years before Social Security starts.
Exactly. The estimated portfolio needed was around $1.2 million.
Wow. That's a big number. It truly underscores the significant financial hurdle of retiring that early as a single person. You're relying purely on your own savings for a long stretch before Social Security kicks in, and even then, it's at a reduced rate.
It really highlights it. Now, okay, let's consider pushing that retirement age back just a bit. Say you aim to retire at 60.
Okay, 5 years later.
5 years later, but you still claim Social Security early at 62. In that case, the target portfolio came in around $1 million.
Okay, so still substantial, but definitely lower than retiring at 55. Those extra 5 years of earning and saving clearly make a difference.
A considerable dent, yeah. But here's where it gets particularly interesting, I think. Compare that with another scenario.
Yeah.
Retiring at 60, same age, but deciding to delay taking Social Security until the full retirement age of 67.
Okay, so waiting 5 more years for the benefit check.
Exactly. In this case, the analysis suggested a portfolio of approximately $1.02 million.
That is interesting because it's actually slightly higher than the previous scenario where Social Security was claimed earlier at 62, even though retirement age was the same.
Right. It feels a bit counterintuitive at first glance. Why would delaying Social Security in that specific case lead to needing a slightly bigger initial portfolio for a single person?
Yeah, it seems odd, but the core driver here is that extended period between age 60 and 67. That's 7 years where you need to cover all your expenses solely with your savings because those Social Security payments haven't started yet.
Ah, okay. The bridge period.
Exactly. Even though you'll eventually get that bigger monthly benefit later on, you have those 7 initial years where your portfolio is doing all the heavy lifting.
Got it.
So it just highlights that delaying Social Security doesn't automatically mean you need less upfront. It's a trade-off, really.
Yeah.
You need more savings to bridge that gap in exchange for having a more robust income stream later.
That makes perfect sense when you put it that way. You're essentially banking on that larger Social Security payout down the line, but you absolutely need the resources to cover those extra income-free years beforehand. It really underscores how important it is to understand your own financial runway, you know? Okay, so let's look at retiring closer to what people often think of as a traditional age. What if your goal was to retire at 65? And you delay Social Security just a bit until your full retirement age of 67.
Right. So working longer, shorter gap until benefits start.
Yeah. In that case, the analysis pointed to a required portfolio of around $736,000.
Now, that's a significant drop compared to those earlier retirement scenarios we talked about.
Huge drop.
Absolutely.
Yeah.
And it really demonstrates the powerful financial impact of working just a few extra years. And delaying Social Security even by a bit, those additional working years, they let your savings grow more, obviously.
Right. Compounding.
And that larger Social Security benefit provides a much stronger income foundation once you do retire.
Okay, and finally, let's look at the latest retirement scenario considered. For those who choose to delay retirement even further, say to age 70.
Okay, maximizing working years.
And also maximizing their Social Security benefit by claiming right then at age 70.
So getting the absolute highest possible monthly payment.
Yes. The estimated portfolio need was, well, much lower, around $479,000.
Yeah, that's the lowest figure we've seen across all these different scenarios we're discussing.
By far.
And that outcome is entirely consistent with the principles we've been talking about, right? By working longer, you naturally have fewer retirement years you need to fund from savings.
Makes
And by delaying Social Security to the absolute maximum, you secure the highest possible monthly government benefit right from the moment you stop working.
It's really important, though, to keep in mind that these figures, they're based on specific assumptions.
Oh, absolutely. Critical point.
Yeah, like a retirement period lasting until age 90 and aiming for what the analysis called a 95% probability of not running out of funds. You mentioned 95% success rate. Could you just briefly explain what that means for our understanding?
Sure. Yeah, a 95% success rate in this kind of planning context, it basically means that the portfolio projections based on historical market returns and volatility and so on, suggest there's a 95% likelihood that your savings, combined with your Social Security benefits claimed under that scenario, would be enough to cover your anticipated expenses throughout your retirement until age 90.
So it's a probability measure.
Exactly. It's a measure of the plan's robustness, against various market conditions and maybe different spending patterns. It's not a guarantee, but it's a standard way to assess the viability of a retirement plan.
That's helpful. Thanks. So yeah, not guarantees, but they give a strong indication of potential financial security under those scenarios. Now, the analysis also touched on something really important. Retirement spending itself isn't static. It changes.
That's right. And it's crucial to factor that in. Retirement spending, it typically follows a sort of trajectory. We often see higher spending in the initial years.
The go-go years.
Yeah, the go-go years, exactly.
Yeah.
When people are more active, they're traveling, maybe doing home improvements they put off. This is often followed by a period of, let's say, lower spending in mid-retirement, the slow-go years maybe,
Okay.
before potentially increasing again in later years, the no-go years, primarily due to rising healthcare costs.
Right. Healthcare is the big one later on.
It really is. And for single individuals, this potential increase can be particularly significant because there isn't a partner to potentially share those costs or even caregiving responsibilities.
Good point.
However, it is worth noting that generally, overall spending in most other categories besides healthcare tends to decline over the course of retirement for most people.
That's a really crucial point to keep in mind when planning cash flow. You might need more accessible funds, maybe a larger income stream in those early, more active years.
Definitely need to plan for that upfront spending.
Now, thinking specifically about our listeners who are single, the analysis also highlighted something we touched on earlier.
Yeah.
You might just need a larger retirement portfolio compared to couples, all else being equal.
Exactly. As a single individual, you just don't have the advantage of shared living expenses. Yeah, think housing, utilities, etc.
Right, economies of scale.
Yeah,
Yeah.
none of that. Or potentially two Social Security income streams eventually coming into the household. You're solely responsible for covering all your costs, 100%.
It's a factor that single individuals absolutely have to incorporate into their planning. You're carrying the entire financial load yourself. And the analysis we've been discussing really underscores this by showing those specific target portfolio amounts tailored for a single person across those different retirement and Social Security ages.
Right, those numbers we went through.
Yeah, we saw examples like needing, around $1.2 million if retiring at 55 and taking Social Security at 62,
The high end.
versus maybe around $1 million if retiring at 60 with early Social Security, or maybe slightly more, $1.02 million if retiring at 60 but delaying Social Security.
That bridging cost again?
Right. Then down to roughly $736,000 if retiring at 65 and delaying Social Security. And finally, approximately $479,000 if retiring and claiming Social Security way out at 70.
Those are significant differences, aren't they?
Huge differences, all based on your choices about timing.
These figures just powerfully illustrate how the decisions you make, specifically about when to retire and when to claim Social Security, can either significantly increase or potentially decrease the amount of personal savings you'll need to aim for to achieve a financially secure retirement as a single person. Big levers to pull.
The source material also really emphasized the critical role of flexibility in your retirement plan. Life happens.
Always does. Things don't always go exactly as you map them out on a spreadsheet.
Not even close sometimes. Unexpected expenses pop up. Could be healthcare, could be helping family, could be a leaky roof.
Right. Or even just your lifestyle preferences might evolve over time.
Yeah.
What you wanted at 65 might be different at 75.
Exactly. So having some sort of financial cushion, some flexibility built into your plan can provide just invaluable peace of mind.
Absolutely. Life is unpredictable, as you said, and having some financial wiggle room allows you to navigate those unexpected bumps without completely derailing your retirement security.
And one final point they mentioned, the idea of maybe doing some part-time work during retirement.
Yeah, as a potential strategy.
Right, to supplement your income, maybe reduce the pressure on your accumulated savings.
And it's not just about the money sometimes, is it? It can also offer really valuable social connections, keep you mentally engaged.
Keeps you busy, yeah.
That's a really practical consideration for many single retirees, I think. Even a modest income from part-time work can make a